Welcome to Capital Link's company presentation series.
Good day to everyone. I am Nicholas Bornaulis, President of Capital Link, and I would like to welcome you to Capital Link's corporate presentation series of 2024. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We have today with us the senior management of Euroseas. We have Mr. Aristides Pittas, Chairman and CEO, and Mr. Anastasios Aslidis, Treasurer and CFO. Euroseas is listed on NASDAQ under the symbol ESEA. Euroseas is active in the container shipping segment and controls currently owns a fleet of 19 containerships. 12 of them are feeder container ships and 7 are intermediate, and Euroseas has on order another 7 feeder container ships that are expected to be delivered within 2024. These are new buildings. In terms of logistics, to remind everybody, we have a presentation followed by Q&A. Participants are welcome to submit your questions through the Q&A button at the bottom of the screen anytime during the webinar, and Aristides and Tassos will reply to them after their presentation. A reminder of the disclaimer that please note this presentation is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities. It is not an investment advice or advice of any kind, and Capital Link bears no responsibility for the content. And let's begin our discussion. I will turn the floor over to Aristides and Tassos. And thank you for being with us.
Hello, ladies and gentlemen. Thank you for participating in this webinar. Thank you, Nico Bornaulis and team, for organizing this event. We will follow a structure whereby Tassos will make a presentation of the company, and afterwards we will be glad to answer any questions that we may be asked. You can send your questions, as Nico said, any time during the presentation. Tassos, the floor is yours.
Thank you, Aristides. Thanks everybody for attending. Thank you, Nico, for organizing. Let me start by making a very quick introduction. I think Nikos already did most of it, so I will be very brief. As Nico said, that we are an owner and operator of container ships. We have a fleet of 19 vessels on the water and 7 under construction, focusing mainly on the feeder and intermediate size sectors, the smaller container ships. Euroseas has been established in 2005, almost 20 years ago, 19 years ago, by Aristides, the family of whom has been in shipping for the last 150 years, so we have a long tradition and history behind us. We have a management and a board that also have a long history and involvement in shipping. All the executive team has 20 and 30 years and more of experience, and all our board members are holding leading positions in their respective fields and have long investment presence in shipping. We do the management of our ships through an affiliate, Eurobulk, which was established in 1995. It's very well respected. We believe in the industry for its efficient and safe operating track record, where as a group, a vertical integrated group, we provide in-house most of the services a modern shipping company needs. So that is a means of introduction of who we are and what we are doing. Let's start by looking at us and the industry. And given the shipping is cyclical, there is no better way to start other than looking at where we are in the cycle. This slide shows a 20-year history of rates and prices in shipping, and indeed it does prove that we are in a cyclical industry. We have pretty good rates on the left part of the slide about 15 and 20 years ago, and more recently during the pandemic years. You can see very clearly here that the industry recorded new highs for both rates and prices. What looks a spike in this chart is not really a spike. It indeed lasted 2 to 3 years during the pandemic years, 2021, 2020, 2021, 2022. So it made an effect on the sector. It allowed companies like us to be able to secure long-term charters. We were able to charter most of our fleet into 2 to 3 year long charters at high rates, ensuring great cash flows and profits for our company well into 2025. Also, that spike resulted in a series of new orders placed by various participants of the industry, opposite to what happened on the dry bulk and tanker sectors. In the containership sector, the industrial players, but also independent owners like us, placed quite a number of orders. The order book increased from a low level of 10% before the pandemic to almost 30%. And that really is going to shape the near-term future of the industry. These developments put in front of us some key challenges for the next year. For one thing is that we have to be concerned now is when the industry will reach a new equilibrium, when that is will be able to absorb the deliveries of the vessels that were placed on order. And as I will try to elaborate in the next 2 or 3 slides, the timing of the equilibrium could be different for the smaller sectors, smaller size sectors that we operate versus the large container sectors. Also, another factor that is now important for shipping is the effect on the supply and operation and economic viability of the ships of the new regulations that has been upon us, the greenhouse gas emission regulations that are part of the general effort by the industry to decarbonize. All of these would be important factors in shaping up the equilibrium. Let me spend the next 2 or 3 slides elaborating a little bit more on the supply side. This slide here gives you a snapshot of the age profile and the order book of the containership fleet, the total fleet. On the top left, there is the age profile of the fleet, and you can see that it's largely uniformly distributed, definitely between the ages of 0 to 20. The fleet is uniformly distributed. The 20 plus age segment is a little bit less than the others. But if you look more carefully in these bar charts and look at the bottom part of the bar charts, you can see that the age profile of the smaller ships is tilted towards older vessels. That is a key point to make, and I will make it a little more clear in the following slide. On the top right, we can see the order book. As I mentioned, it hit 30% sometime in 2023. It has come down to 25% as a ratio of the fleet to the fleet now. But indeed, there is significant order scheduled to hit the market in 2024, 11.4%, and 6% in 2025, and so on. So this is the challenge that the industry has to absorb these deliveries that are coming in. This slide is sort of the same, but only for the feeder vessels, the 10 to 3,000, the 1,000 to 3,000 TEU segment. And that makes even clearer the point I made earlier, that in this size segment, where the majority of our vessels operate, the fleet is rather old. There is a good 25%, 24% of the fleet older than 20 years of age. At the same time, the overall order book is much smaller. There is only 8% expected to come into the market in 2024. So you can see immediately the dynamics. If half of the 20 plus year old vessels don't survive the year and only 8 come in, you can even have a fleet size reduction in this segment. The same is true for the intermediate size segment. Again, here too, the age profile is tilted towards older ships. The order book is even smaller. We have 6 vessels operating in this sector. So we expect to see hopefully an equilibrium point being hit earlier in that size segment as well. So on the supply side, this is the situation, but that's half of the equation. The other half is demand. And here, really what we care to understand is the growth of containerized trade. And as this chart here makes the point, this is quite linked and quite related to the economic development. This chart shows the world GDP growth and puts it next to the containerized trade growth. And you can see, at least visually, there is a pretty high degree of correlation between the two. But the size of the containerized trade is not alone the factor that determines demand for container ships. There are other factors. An important one is the routes over which the trade takes place. So the distances are very important. Also very important is various congestion points or throughput limitations. And this factor has been quite important during the last 4 to 5 years. It's important right now. I mean, during the pandemic, for example, there were significant port congestions which tied up ships and increased demand for ships. Right now, there are certain canal throughput constraints in Panama Canal in particular, when there are restrictions due to the shortage of fresh water. And also there are additional factors like the hostilities in the Red Sea create a certain degree of additional demand because ships avoid that region and take longer routes. So this plus effects that had to do with the speed at which ships are running also affect demand. For example, slow steaming, which could be a result of running slower to economize on fuel or running slower to reduce greenhouse gas emissions, definitely affect the availability of ships and thus increase the demand for more ships. So all of this will shape our industry and create a quite uncertain landscape for 2024 and 2025. Thus, summarizing the demand size picture, we have to balance, as I said, the capacity increases that are expected because of the order book with the additional factors that could, in the interim, result in higher demand for shipping. In general, in 2024, we expect to see softening the container freight and charter markets. Again, as I mentioned, because of the increased deliveries, especially when or after the Panama Canal and the Red Sea situations are resolved. While these situations are in evolution, while there is restrictions in Panama Canal or hostilities in the Red Sea, we have seen, and we probably expect to see the decline in rates that happened in the latter part of 2023 being arrested. In fact, rates have increased by about 10% over the last month. 2025 is when we expect to see a broader equilibrium in the markets, especially if significant number of ships get scrapped in 2024, or if demand remains resilient in 2025, and new orders from this point on are less, players are more disciplined in placing new orders. All this could result in making 2025 the equilibrium year for the broader fleet. But as I mentioned earlier, we expect and we hope to see equilibrium in our size segments being reached earlier. Whether the reaching earlier this equilibrium and reaching earlier turning point in rates is something that will happen is yet to be seen. So within this market background, let's now turn back and see how we have positioned Euroseas. This is our 19-vessel fleet that we have currently on the water. 12 of them, as I mentioned in the beginning, are feeder ships. The 7 of them are intermediate-sized container ships. These are new building vessels. All of them are feeders, 4 2,800 TEU and 3 1,800 TEU. And this here is how our fleet is employed. This is the contract snapshot, the chartering profile, the current chartering profile of our fleet. It is important to notice that in 2024, more than 70% of our available days are already contracted at an average rate in excess of $30,000 per day. And in 2025, more or about 23% of our fleet, of our available days, are contracted at an average rate of almost $34,000 per day. Clearly, what we're working on is chartering out the remaining of our new buildings and, of course, chartering the vessels of our existing fleet as they become open. Let's now look a little bit at our financials, and let me start by looking at our 9-month figures that for 2023 that have been that are already public. The first 9 months of 2023 were very profitable for our group. We recorded total net revenues of about 140 million. We had adjusted net income of almost 79 million, which translated to $11.3 per share. We had EBITDA in excess of 90 million, and we earn on average almost $30,000 per day per vessel. All of this allowed us to give $1.50 per share dividends to our shareholders, and in addition, allowed us to spend more than $3 million to purchase back about 160,000 shares of our stock, a little more than 2% of our outstanding shares. Based on that, and based on the contracted picture I showed you earlier, 2024 starts from a very good point. Although rates are back down to near pre-pandemic levels, our contracted percentage of the fleet is shielding us from that low market environment and will allow us to fund our dividend, continue funding our dividend, continue funding the equity portion of our new building program, and still have considerable liquidity available for further investments if investment opportunities appear in front of us. To underline the point that we have sufficient cash available, this chart shows you our projected cash flow break even for the next 12 months, which, as you can see from the last bar at the right, is around $14,500 per day per vessel. As I showed in the previous slide, we have our contracted employment is in excess of $30,000 per day. So you can appreciate that there is significant margin there to fund all of those investments and dividends and new building programs that I mentioned in the previous slide. A quick comment on our balance sheet, where I would like to highlight really the low leverage that we have in our group. As of the end of last year, we had about 131 million of debt, which represents a loan-to-value ratio of 49% if we use the charter-free values of our ships, and 37% if we use the charter-adjusted values of our fleet. Not only that, just the scrap value of our existing fleet, the 19 ships that we have on the water, is more than the current debt that we have outstanding. So I cannot underline enough that we're a low-levered company right now. Of course, we are going to assume additional debt to fund the remaining of our new building program, the 7 vessels that we're going to take delivery in 2024. We are targeting a 55 to 60% debt level on the basis of the contracted prices of that fleet. But overall, that new debt will still allow us to maintain a leverage ratio of about 50%. So a low leverage balance sheet going forward. Then we come to say why all of this should make you think about Euroseas and investing in us. I can think of several reasons. I mean, for one thing, we have insulated ourselves by the current market environment. So 2024 should be comparably profitable to 2022 and 2023. And those 2 years were quite profitable. And also, because of our conservative finance, we have minimized all kinds of risks and increased our flexibility to fund both our investments and pursue new ones. We do have a strategy, and we have the capacity to grow and modernize the company. We have built in our organic growth through the new building program that I mentioned. It was a 9-vessel new building program. 2 vessels were delivered in 2023, and 7 we expect to take delivery this year. Total contracted price for the entire program was 360 million. So a significant investment on behalf of our shareholders. Given that liquidity flexibility that we have, we continue to be alert and continuously evaluating and targeting selective acquisition that would be accretive to our balance sheet and to our earnings. Within all this, we have a very conscious and focused strategy to reward our shareholders. We have instituted 2 years ago a dividend that currently pays at today's price about 6% annual yield. And we have, as I mentioned, a share repurchase program. All of these reasons are important, but one more important reason is that we still trade at 60% of our net asset value. That represents a significant, not only significant discount, but represents a significant appreciation potential. And that is despite the fact that our share price has increased more than 80% over the last 12 months. So with that, I would like to stop my remarks in presenting a quick overview of the company and market. And Aristides, should we open the floor for questions and try to answer some questions?
Yes, let's see what questions we have received in the Q&A part here. I see one question here saying, you definitely concluded charters at great rates over the last 2 or 3 years. As the market has declined significantly, have you been approached by your charterers renegotiating rates or asking for accommodations? Well, indeed, we have had one case where we had one of our charterers default on a charter that we had. It was the only fixture that we had done with a small charterer, and he defaulted, and we are in litigation with him, and we'll see what will happen after that. The remaining of the charterers are all top-class charterers. All these first-class people, they have accumulated significant earnings and profits over the years, so they are in a very strong situation. I don't expect us to be facing any problems from these major charterers going forward, even if the market deteriorates further. There is the capacity there, obviously, for them to continue paying us. So I'm not really worried about that. I see another question here saying that from your chartering slide, it is clear that the source of uncertainty is the chartering of your new building vessels. I understand that the next one coming out of yard shortly has been chartered, but what do you believe are the prospects for the rest? Do you expect them to earn any premium over ships of previous vintages? Well, indeed, as Tassos said, we have covered 70% of our operating days for 2024 at rates in excess of $30,000 a day. The ships that open up this year, but also the new buildings that are about 15% of our operating days still open, that come from the new builds, are not yet chartered, and they will not be chartered, as I think, at these $30,000 a day rates. They will be chartered at lower rates. The first new building that is being delivered this year, the 2,800 TEU vessel, has just been fixed at $17,000 a day for 8 to 10 months. This is the type of level that I expect to be seeing in today's market. Of course, everything will depend on how the markets develop, and Tassos explained that very well, that although we were generally quite bearish, suddenly this stuff that is happening in the Red Sea is creating inefficiencies, which always help, and therefore charter rates have started rising. But we will be fixing the ships. The new ships will be very, very easy to fix at the market rate. What the market rate is depends to be seen. Today, for the 2,800, it's $17,000 per day. If it was a conventional ship, it would have been around $12,000 a day. So we do get a premium of $4,000 to $5,000 a day for the modern vessels, which premium comes why? It comes because they consume much less fuel than the older generation of vessels. This is the main attraction. There are other attractions, the fact that we have AMPs on board the vessels, which mean that at ports we can use electricity from the ports where available. They can take more containers at a lower depth draft. So there are other advantages, but the main advantage is you consume 40% less fuel approximately at the speeds that we are trading today. Another question here is that as a shareholder, it has been great to see that some of the cash that the company accumulated has been distributed as dividends or used to purchase back stock. Yes, indeed. Can you share with us what is the strategy for dividends going forward, and especially in light of a weaker market expected? Well, we do definitely expect the dividends to continue. Our strategy has been always to return money to our shareholders. We did it since the inception of the company back in 2007 for 8 years continuously till the markets really collapsed and we weren't able to continue that. We started this policy again as the markets improved in early 2022. So we've done that for 2 years now, offering 50 cents dividend. It's not a lot of our current earnings. It's a level that we can continue supporting even with much lower earnings. It only represents about 15% of the earnings that we have been having the last few months. I'm very confident that dividends will continue. We think that we should be paying a dividend which is higher than what somebody can take from a bond or from a safe bond or from having his money as cash. So I'm pretty sure that a dividend yield of around 7% is something that we should be able to continue giving, going out in the future as well, and certainly very easily for the next couple of years. Another question, as rates declined, prices for second-hand vessels have or will decline too. What is Euroseas strategy regarding buying second-hand vessels? Will you take the risk to invest in older ships? Well, there's two questions really here. Of course, prices have declined and are continuing to decline, and they are still a bit above historical average values. Of course, we have a very significant cash holding right now, so we are waiting to find opportunities to invest the extra liquidity we have. So if we do find opportunities that are attractive, we will be buying more ships. We are easily capable of handling technically older ships, but older ships today have various issues regarding the CII and the fuel consumption that they have, so they are not a long-term proposal. We evaluate the markets continuously, and when we see projects that we expect to yield a return higher than 15% on our equity, we usually look at them in more detail. We will be investing more when the right ship appears. I can't say more. Another question here is, what are the risks of having to renegotiate, like lower for longer? There's been one charterer that asked us that question. Indeed, one of our charterers did ask that question. We replied with what we felt was a good deal for us. They didn't like what we offered, so we continued as previously. We have strong charters. We will only do something differently if it's for the benefit of our shareholders in the longer term. We had one charterer, Zim, I'm saying this because this is something that we did about 5 or 6 months ago, who wanted to terminate the charter, and we could find a better charter in the market. We agreed to terminate that charter, and we got the better charter in the market. We feel very confident that whatever we need to do, it's for the benefit of the shareholders. Another question is, when is the usual time to recharter the ships? I.e., is there a specific time frame, first, second, or third quarter? We charter the ships very close to the period where they are expected to become open. So usually we fix a ship that comes open next month, this month. It's not a period now where you can charter forward the ship that will open in 3 months' time or 6 months' time. The market is really acting more on spot vessels, and that's what's going to continue, I think, for the next few months. Can you give us an example of the names of your significant charterers? Maersk, CMA, Zim, Asiat Shipping, Hapag-Lloyd, RCL. We talk to all the major charterers in the market. We've got great relationships, and yeah, that's it. Are you currently avoiding the Suez Canal? Do you foresee any change in insurance costs going forward due to the Middle East issues? How much do you pay per day for insurance now? We have been going through Suez Canal. The answer up to now is yes. We monitor the situation on a daily basis. We haven't had many ships, to be honest, going through the Suez Canal the last month, which has been the dangerous month. If the charterers want to do it, we will probably do it. They will take the extra insurance costs to do it. We will see. I think that the situation will improve. If I may make a comment here, I anticipate that with all this force that the Western world has sent in the area, we will not have many incidents. But the truth is that up to now, we have had a couple of instances. Luckily, there has been no loss of life, which is the most important thing. And everything else is really insurable. Next question is, why would you use feeder or smaller 4,2.5, 7,500 TEU vessels versus 10 or 15,000 TEUs? Well, the answer here is that the smaller vessels serve different markets, right? The big transatlantic trips and transpacific trips, and from one ocean to the other, are usually served by bigger ships, 10 and 15 and 20 and 24,000 TEU ships. But for smaller ports where you cannot fit the big vessels, for smaller distances, for areas where there's not too much demand for so many container ships, you need to have the smaller ships, and you will continue using the smaller ships. They will not disappear. There is very, very many ports that cannot fit the bigger ships. Another question, where are and how are rates today versus before the Gaza war? Well, if you just look at the context index,
10%.
It has risen by 10% from December to where we are today, from end of December to where we are today. Next question is, what is the typical age to scrap ships? I understand they last longer than dry bulk or crude. Technically, the ships can last for quite some time, and the average scrapping age for container ships has been around 25 years, depending on the period of time where we are. In bad markets, you scrap younger ships, so the average scrapping age may go down even up to 20 years old. In good markets, you see the average scrapping age going up to 28 years old. So now this is changing a little bit because of the regulations concerning the environmental issues. Now with the CII requirement, that might make ships obsolete sooner. So we might see the average scrapping age go down going forward. Another question, how available is LNG ammonia at the various ports? Not available at all. Ammonia nearly nowhere. LNG in very few ports in the world today. The adoption of these fuels is going to be very gradual, late, and it will start with bigger vessels that go to the bigger ports. The smaller ships will be followers in that area. Another question, charters at 17,000 versus costs of 14,000 reduces your margin significantly. So can you maintain your dividend? Even at a charter of 17,000 versus a cost of 14,000, one can really maintain his dividend, as you see here, this type of dividend that we are giving, which we know is a low dividend for the very good years that we have had in 22 and 23. But we think that the shipping business, the business we are in, provides an overall return on average of at least 15% return on equity. We want to be returning close to half of that to our shareholders and keeping the rest for growth. So I think that we will be able to dip more in our earnings so that we can keep the dividend if the market is low and continue paying the dividend. From all the shipping companies in the Capital Link platform, Euroseas is the only one to use the EBITDA term the least. In our strategy, this is excellent and unique. How do you explain that in your strategy going forward, 5-7 years from now, 29, 2030? Thank you. I don't really get the question. I think it's a compliment, but I'm not sure. But the renewal that we are doing in our fleet with these 9 modern vessels, I think is a first step towards reaching 2028, 29 and 2030, as you say. We have a huge capital buffer that will allow us to invest more when we think that the returns are there or will be there. So we are very confident looking forward.
I think, Aristides, if I can add here, I believe the question is that in a cyclical industry like ours, using the EBITDA to multiple to value the companies might not be as reliable or as easy to do as in other industries. We indeed focus a lot more in our presentations in using NAV as a yardstick to underline it or to indicate what our value is. And I believe this is what the person who placed the question wanted to underline.
Okay, true. Next question, do you expect reduced shipping from onshoring being promoted today?
I think
There is this issue. Go ahead.
Moving the production of goods near the consumption areas, basically eliminating the shipping part of it to control better the supply chain situation. I don't know yet to what extent that has made an influence, but of course, if a lot of production comes from China or from the Far East to Mexico, so it would travel over land routes to the United States as opposed to shipping routes. But this trend, I don't think it has taken a big hold yet. I mean, it's obviously happened to some extent, but clearly would have an effect if there is onshoring.
No, there is this. There is definitely this deglobalization case that is happening because of global politics. It doesn't make economic sense, and I don't think that at the end of the day it will prevail. I think it's more today, you know, this period of time because of the geopolitics that it is being promoted. But as it doesn't make economic sense, I don't think that it will prevail at the end. Next question, running around Africa would increase the need for ships by how many? I can't tell you the exact number of ships that it will increase the need, but it is quite substantial. And we are seeing how it is already affecting freight costs primarily, which have doubled overall, but charter rates as well that are already increasing. Why to keep a dividend that high instead of using those money to pay back the debt or buying newer ships? Well, it's not high. Paying 15% of your earnings as a dividend is extremely low. But it still is, you know, with the increase of our share lately, is a 6% return to our shareholders. It used to be more than 7% when our share price was lower. We think that our shareholders deserve to have some payback in form of dividends, which, as I said previously, is more than having the money in the bank.
And I think we try to do we do everything. We do a balanced strategy. We pay dividends, we repurchase shares, we invest. We try to balance all of our options.
So, and the final question that I see here is, do you expect any of the current fleet to have below average ratings DE when calculating the CII rating? Well, in 2023, there was only one of our vessels that was rated E. It is the motor vessel Marcos, which is now programmed for its scheduled dry dock. We will be replacing the propeller. We will be changing the bulbous bow. We will be painting it with silicone paints and effecting some other changes. And this will improve its fuel consumption, we believe, by around 20%. And thus the vessel will go down to CII rating C. So this is something obviously that we monitor very carefully because it is becoming important, and it is probably one of the reasons why you might see scrapping ships younger than before, as I already said. So this is something we continue follow. For the next couple of years, we feel that all our ships at least will be able to trade technically and satisfying the CII requirements. I think this completes the questions that we had. There were quite a few. I hope we've answered them as clearly as possible. I want to close this session here, thanking you for listening to us, confirming that we look forward to what's coming the next couple of years with optimism, and we should get the opportunity to continue growing the company and returning money to shareholders.
Let me add
Thank
my
you.
thanks as well to Aristides' thanks and to Nikos as well for organizing all this.
Thank you, Nick.
My turn now to close, and thank you both. Thank our participants, first of all, and of course, Tassos and Aristides. I think you got an avalanche of questions, which is indicative of the interest in the sector and, of course, in Euroseas. So with that, thank you to everybody. Just to remind you that this webinar will be available also for access upon demand on our website, capitallinkwebinars.com, and also on Capital Link's YouTube channel. And with this, thank you, and have a great rest of the day to everybody.
Thank you, Nico. Thanks.
Thank you, Nico. Thank you, everybody. Goodbye.